Hello, everyone, and welcome to another episode of the Real Estate Development Insights podcast, where we bring you ideas, experiences, and best practices from the real estate development industry. My name is Payam Nursalahi. I'm the president of Dena Project Management, where we help developers define, design, and deliver successful projects. My guest for this episode, I have a very special guest here. I have Peter Norman. He's the vice president and economic strategist, chief economist at Altus Group. Different titles, different places. Bottom line is that Peter is an economist who's been around for a long time. He knows the industry inside and out. And before joining Altus, which he's been there for quite some time now, I think about 17, 18 years now. Before that, he was a vice president at Clayton Research Associates. And prior to that, he worked as an economist for Bank of Montreal. For those of you who are not familiar with Altus Group is a commercial real estate advisory firm that provides data, software, and cost analysis tools to people in the industry. It is one of the go-to resources for anyone who works in the real estate development industry, commercial, specifically the commercial sector, and we rely heavily on their input in making our decisions. Happy to have Peter here. As always, you can find all the relevant information and links on our website, realestatedevelopmentinsights.com. That's all one phrase. And please remember to subscribe to our show, tell your friends about it, and hopefully they can help us together grow the show. Hey, Peter. Glad to have you here. How are you doing today?
Really great to be on your podcast today, and thanks for that very fulsome introduction. I always like to be on a show or a podcast where clearly the host has done his homework. So that's good. That's a good start to the day.
That's good. I tried my best, so you tell me at the end, how did I do? Before we dive into all the questions, which I have quite a few of them, do you want to give us your version of that intro?
I thought that it was great. I have certainly been a long-time industry watcher. I'm located in Toronto, so a lot of my work over the years has been in Toronto and the GTA, but I have run a consulting practice for the last almost 30 years, which has been focused on the national picture, on the Canadian market. I've worked for clients in all of Canada's major cities at one time or another. In the end, a lot of my work has been Southern Ontario focused just because of proximity. My time at Clayton Research, you mentioned Clayton Research, and then moving into Altus, it is one and the same in the sense that we merged. We merged our partnership into Altus a number of years ago. The economic consulting practice that I have been responsible for has a fairly long lineage going back and a lot of clients. And although Altus now isn't doing as much of the point-to-point consulting work at this point in time, we're dealing with larger strategic issues in the real estate market. I continue to speak to the market, not just from my own long experience, but for being in a group where I can lever pretty heavily, and I often do heavily, off of the expertise of my valuation colleagues, for example, who are the best in the world at assessing the value of properties now and why and where they're going and those sorts of things. And also, of course, my construction cost colleagues who, again, have an extremely deep understanding of that market, and I'm continuously tapping into their expertise as well in order to understand what's happening on that side. And that really puts us into a real kind of full service side of things, particularly for the type of topic that we're talking about today, where it's not just the macro that's driving the need for missing middle housing or infill housing. It's not just where the population is and the demand is, although I'm sure we'll talk about that, but it's also where is the feasibility of building this stuff that has to do with land value, it has to do with construction costs. So really happy to have this lineage coming into your podcast.
Perfect. And I'm happy that you're here. We can ask you a whole bunch of questions. Speaking of homework, I want to go back to a little bit of a homework that we did before this episode. On December 5th, 2024, so almost a year ago, roughly 11 months ago, you guys had a post on Altus, a blog post, or I think it was a summary of the webinar, if I'm not wrong, that the title was "A More Promising Year Ahead of Canadian CRE, but Patience is Still Required." That was the caveat. And there are a few points in that blog which I want to start touching on. And my hope is that throughout this episode, we can go look at the macro level, Canadian economy, and if you want to expand on that, we can definitely do that. And then try and dial into the micro level and GTA level, Toronto, and even GTHA level of surrounding areas, and talk about trends and what's happening on the streets, basically. So in that article or post, you had flagged that shifting demographic demands away from starter homes to properties that accommodate older groups is a thing. That was one of the things that was flagged there. The other thing that you had flagged in that report was obviously the multi-decade low sales. Basically, that's what we're seeing and hearing. We're at a point that the sales for new properties is at the lowest point it has been ever for probably as long as I've been alive. And one of the other things that you guys had was that you thought that the interest rates are going to settle, which I think you were kind of bang on around 2.5%. If you were to go back and look at that title with those key points in that report or that blog, how do you feel about that?
You've asked the most challenging question of an economist, and that is going back to something we said and having to defend it. But in this case, there were a number of factors that we were looking at going into 2025. And in a large sense, a lot of stuff has played out. But obviously, 2025 has played out differently from a global macro perspective for a number of pretty obvious reasons. And to some extent, a lot of that disruption that happened in 2025 is what I like to call internalized. It's a 2025 issue. It's like 2025 hit the pause button on the economic cycle. And that's because a lot of obviously the disruptions I'm talking about have to do with the swiftly changing policies out of the United States on issues around trade and sovereignty and other issues. But a lot of the economic impacts that have come from that disruption and the chaos have been interruptions of uncertainty, calling it like an economic haze or an outlook haze. I've used that term a few times, where everybody just gets very concerned about the change, and businesses hold off on investment, and consumers to some extent hold off on purchases, or at least big commitment purchases, and they wait and see what's happening. And now we're 12 months past that kind of outlook that we looked at before, but we're also a number of months into this period of chaos, et cetera. And I would say things are settling down. We still have very disruptive policies, obviously. But one thing we're seeing is that as the clarity of the new policies come into view, businesses start to be able to make decisions, consumers start to be able to make decisions. We all just need to get on with our lives. And so to some extent, we paused, and now we're here. So I said all of that by way of saying that you read to me some headlines for what I might be saying in an outlook 12 months ago, and we might be saying the sort of the same thing right now. It's almost like we've paused everything. The population comments that you referred to, and I can talk more about that in our discussion today as well, they came from a Canadian federal government policy change that had just been announced in October of 2024. As I was doing my year ahead work looking at 2025, I was quickly having to calibrate to this new immigration announcement. Now we are almost 12 months in, and we've got 3/4 of data that are affected by this announcement. And we are being able to calibrate much more closely what's happened and where we're going with the massive changes to the demographics. But they are playing out what my preliminary views had pointed to. And that view we can talk about more, but we're still in that picture that the immigration changes really do have a fairly dramatic effect on housing demand. And it's not all negative and it's not all positive, but it has a dramatic effect, and we need to be paying attention to that. And then just a general macro environment where maybe interest rates have cooled a little bit. I expect there to be at least one more cut from the Bank of Canada, but I do think that we're pretty close to that kind of natural rate that is not too stimulative and not too constraining. And that may come next week, or it may come over the next couple of announcements, but we'll probably see one more cut. And otherwise, here's looking to 2026 as that kind of modest recovery from the soft landing.
Okay, so that's where I was going, because the next blog post that I have here is from September 17, 2025, which is pretty recent. And it's exactly what you were just saying. And I want to double click on that. Obviously, I agree with the whole conversation about the interest rates. We hear about it. There seems to be that common sentiment on the market that it is going to happen either in October or November, or some point there's going to be another rate cut, which is definitely helpful at this stage. And on the flip side, I can say that over the past 2 or 3 months, so at least I can talk from my own experiences, that a lot of projects that were shelved entirely and no one was even talking about them, we see and hear some rumors and whispers, and people are thinking about trying to bring them back to life. And we were talking with a colleague of mine, the fact that the interest rate savings on a $30 million job that happened over the past 3 months is less than $200,000. And a $30 million job is not a make or break. With $200,000 doesn't make or break a $30 million job. The part that is, I think, or I feel is happening is what you just said, which is the uncertainty. Is that it almost feels like the investors or developers who were in that realm, they're like, you know what, okay, this seems to be the near reality, and let's try and figure out how to make it work. We can't just sit on the sidelines anymore. Is that an accurate interpretation of what you said?
We'll be right back.
Just a quick announcement. If you're thinking about financing your next project, your next rental project through CMHC, and in particular about the MLS Select program, please go to our website and check out our new webinar series. It's a free webinar series where we're talking about different aspects of the program, how you can qualify, how you can get more points. And we basically break down exactly what you need to know to access better terms, higher leverage, and longer amortization. Again, it's free, and you can find more information about it at mid-rise.ca/webinars, midrise.ca/webinars. Thank you.
Yeah, I think all of that is true, and probably more factors as well are in place. I will say something in addition about the interest rate piece. Policy rates are important, obviously. A lot of stuff gets priced off of that, including the prime business rate, et cetera, that affects a lot of these things. But we've actually seen very little change in the 30-year Canadian bond, so bond yields, through this whole, so I'm not through the whole interest rate cycle. 30-year bonds rose during the upside of the cycle. But since about the middle of 2022, it's been very stationary, and it also hasn't been reacting downward as quickly as we would expect during the unwinding cycle that began about 12 months ago, began earlier this year. And to some extent, in the commercial real estate world, a lot of stuff is priced off those longer bonds, not necessarily just in the financing world, but also when you think about cap rates and where they are and what's driving them, a lot of that is being driven off of sort of long bonds. And we've continued to not see that kind of cap rate compression that would signal more life coming back into that sector. So, I think that as we get into a more stable, lower interest rate environment, we may start to also see that yield curve starting to flatten out a little bit. But right now, the long bonds continue to be relatively elevated right now, and that continues to be of concern.
And then I guess, that's more even to say that the numbers haven't really changed, if I get that, but it's maybe the new realities is just kicking in.
Yeah, I mean, I
think
the realities you've mentioned are kicking in. One being, that I think early in, we're in a what you might call a condo crisis right now in general across a number of different typologies. In fact, all new housing, basically. Even on the single family side of things, there continues to be land shortage issues around this. But leaving that aside from a short-term picture, both single family sales and apartment sales in Toronto, in the GTA so far this year, are down about 50-60% from last year. But of course, last year and the year before were also down. So right now, we're looking at both sets of sales ending off this year being something like 90% lower than the 10-year average going into this year on both segments. That's a demand crisis. into this. And we're focused, obviously, on financing because that's important and that can make or break the go or no-go decision by a developer going forward. But in the end, if you're going to bring a project forward, you have to do one of two things. You have to pre-sell those units to potential buyers, and those might be investors or they might be end users. Or you need to build it speculatively and plan to either sell them or rent out if the rental project, rent out, lease up that project when it's completed. And then all of that needs to be at a revenue that makes the project work. So, that's where you need to be. And I think that when you're looking around and every condominium project around, and there are still dozens out there, but there have been about 30 projects started just in the last 18 months or so. And you look at these projects and their sales are in the 3 to 4 units per month range.
Yeah.
Then that's not giving you that's not very auspicious for your ability to bring this project forward. What might be changing now, or how might 2026 be different? Part of it would have to be that we're going to see a pickup in the ability to bring a project forward that can sell to a buyer who's likely to buy it. And I think that the winning conditions for that, first of all, let me just step back a little bit and give some context for that, is that people want homes and people want to buy homes. And we know that because the resale market is okay. Not frothy like it was post-pandemic, but it's a great market right now. Things are selling. And the resale market adjusted in the GTA by 25, 30% or so, depending on the segment and the area, back in 2023, 24. But prices are steady now. Sales transactions are happening. And so there are buyers out there. People want to buy homes. So this is not... Right. I remember the 1990 problem with new housing, which was also a resale problem. It's just nobody could buy and buy. So this is not that. So somehow you need to convert a potential resale buyer into a buyer in your project. And I think that buyer is not going to be an investor right now because investors don't have the confidence in the value uplift of that unit. Probably for good reason, because I think we won't be looking at an immediate cycle of value uplift right now. And there's still some nervousness about the legs behind rental demand as well, which would be the other concern about an investor buyer. So I think that the buyer that you're going to convert into your project from the resale market is going to be an end user. And what is the age and stage of that buyer in? It's probably not going to be a young single person looking for a very small unit because that's the softest demographic that we have right now. And it's probably not going to be somebody who wants to wait 7 years for that unit to be delivered to them. And so that means you need to design a kind of project that can deliver fairly quickly and can deliver the type of product that people are looking for. And that's probably the winning combination for 2026.
This sounds very true to what I'm seeing in the market right now as well, based on discussions we're having. There's the general sentiment that the condo comeback, it's still ways away. There's still, we need to see a whole bunch of different things happen for the comeback of the condo market. But I want to go back and double click on the population factor that you've touched on a few times. And obviously it's a very significant factor. And I personally don't think that it's getting enough attention in our conversations in the market. Like we hear about the development charges, we hear about the sales, we hear about the construction costs raising, we hear about a whole bunch of we hear about approval processes, but very rarely anyone really correlates this back to the population and what's happening over there. And I'm hoping by end of this conversation, we can leave a better picture for someone who is about to start a rental project, who is about to start a 6-plex or a 60 unit or a 600 units rental project, and try and get a feel of what is it going to look like. Because I'll tell you that over the past few months or number of months, we've had multiple conversations with people who are looking at rental projects. And one of the things that keeps coming up is that they hope and feel and need that the rent is going to pick up toward the end of this decade, like in the next 2 or 3 years. And that would be, from my perspective, that would be contingent on population moving in the right direction. And also, I want to flag something which it might not be a fair question to ask you as an economist, but I want to flag it because I'm seeing it. And that is the cultural shift. Like when you have properties, I was watching the news a couple of nights ago, and there was this whole section about now there are houses in GTA area or Ontario that are housing 14, 15, 16 people, different generations, different family members, all in a semi or in a fully detached house that used to only house 3 to 5 people. Is that also something that we need to think about? Is that a stickiness factor? Is it a cultural shift that may or may not skew some of these other numbers we're looking at? So with all that to say, the mic is yours. Let's go from there.
Well, I really appreciate that setup. So let me just start from some sort of the basic facts of what we're facing right now. And I think that was the first part of your question. I've been monitoring GTA growth and growth management now for several decades. And the rule of thumb and the way it more or less played out for many years was that the GTA grew by 100,000 people every year. We used to say that an easy way to think about the GTA growth is that you just add Barrie every year. You take Barrie and you add it every year. And that's more or less actually how we grew.
Good rule of thumb.
It gives a real context, right, of how many, not just how many homes you need, but how many shopping centers, anyway, nonetheless, I won't go down that path at the moment, but that is a growth management rule of thumb, which is pretty interesting. And then in the froth of the post-pandemic period, we had immigration numbers rising, and we also had the intake of quite a lot of non-permanent residents into Canada in general, but into the GTA. And the GTA population growth started growing by about 290,000 people per year for a couple of years. Now, that's almost 3 times that rule of thumb that I just talked about. And there was stress that comes when you change. It's not to say that the GTA couldn't be a region that supports 300,000 in growth every year. Maybe not. But it's to say that if you go from 0 to 60, sometimes you're pushed back into your seat, right? And it takes time to adjust to that. And so that's been the reality recently. But with the federal immigration changes, they've hit the GTA fairly heavily. And they've hit the GTA fairly heavily because a lot of the growth that we have been having has been amongst temporary residents. It's not to say that it's temporary and they're leaving. They might be, but it's up until recently, that level of temporary residents just kept growing and growing and growing. And so it is a population. They are warm bodies. It is people who require housing and go to the mall and buy things and all the rest of it. It's a growth like any other. But nonetheless, the population changes that have that non-permanent side of things declining has hit the GTA pretty heavily. And at the same time, we have had this emerging trend, you might say over the last 5 years since the pandemic, but it does, when we look at the data, it does extend back further from that as well, which is like affordability refugees, you might say, which is to say that people at a certain age and stage of life leave the GTA because there's more affordable housing elsewhere, or there may be a raft of other reasons. So we've always had this push towards what we call out-migration or intra-provincial out-migration, people leaving the GTA for points close by where they can either come back from work, but of course with some hybrid work, it's made it easier for people and so on and so forth. So that trend is underlying. And so as a result of all of that, in the past 12 months, and this is an estimate, but it's an estimate done by the Ontario government. So it's one, and I think it's one that I think we can have some confidence in when we look at the market anyway. But anyway, in the last 12 months, there has been a decline of 20,000, actually a little over 21,000 people in the GTA. So I'm not saying that the 300,000 has moved down to 280. I'm not saying it's not a marginal term. It's like it was 300 plus, now it's 20 negative. And that's a pretty stark difference. And when you look at where that's likely to go in the next 5 and 10 years, this is what's important for our growth. It's going to be negative for a few years, and then it will start to get positive. But even once it's positive, the expectations are, at least under these current environment, that growth will be more like about 50 to 60,000 per year. So it's only half of Barrie, or maybe a third of what Barrie will be at that point in time. But significantly lower than that pre-pandemic benchmark that I spent time talking about, but definitely a lot lower than before. That seems like a bleak picture. for a developer, because I just spent some time talking about how what needs to be done is you need to identify that buyer, that potential resale buyer that you can convert into a new home buyer. But it does seem like it's not going to be so easy to find that buyer in this picture. And that might be the case. But the other part of your question I thought was very telling, because it does get me into an element of growth management, which is pretty important for the way that we look at this and go forward, is that by taking the valve off the pressure cooker, we're allowing some other stuff to take place. And what we think is going to happen is that this will be an opportunity to release what we call pent-up demand. You describe it in a different way, but we call that pent-up demand. And this is young people who are still living with their parents, sometimes for many years, past the time that they're finished school. It can be young people or even other generations bundling up together, like living as roommates or living in situations that are not necessarily the sort of traditional way that we see demand playing out. And from my perspective, I look at that. I'm just going to make a kind of a technical modeling thing here. I look at a thing called a headship rate, which is I look at people at different ages and how many of them are the head of a household. This gives us this in the modeling world. This gives us our path. And with that, I can measure what is that quantum of pent-up demand, because I can look at the headship rates from previous times. And they would be reflective of well, you mentioned cultural. We'll leave that one aside, but there may be some issues around that. But I think more importantly, they're reflective of the affordability situation and the housing availability situation. So those two things in particular that get reflected. So when I go back to looking at, say, 2016 in the GTA or 2011 or 2006, going back a number of years, these headship rates were more accommodative than they are now, particularly for younger groups, particularly for those who are under the age of 45 years old, basically. And so when I model going forward, I can take a flat population, like the way that we have right now. It's going to be flat for 8 years, basically, is what I was describing. Right. But if we're able to release the pent-up demand, if we're able to get people to consume housing the way they did back, say, in 2011, we're able to get back to a situation where we need something like about 30,000 units per year going forward, which is pretty similar to what we were before. But before pretty similar to what we were delivering before. But before we were delivering an insufficient supply for a much higher population growth. This is delivering a sufficient supply to release some pent-up demand. And so that's what's pretty important. So one of the things that I told the Missing Middle Conference when I was speaking at that a couple of weeks ago was that my expectation is that our need is for about 30,000 units going forward, and that's still there. But I will just give one kind of caveat for that. It doesn't magically happen.
True.
You don't magic, just because I've stated it, that you can go back to an earlier time. That doesn't take a 24-year-old out of their parents' house automatically and put them into their own condominium apartment or rental apartment. What has to happen is that the price of that house or the rent in that apartment needs to better match their needs and affordability. And what we need in order to get to this situation where we get back to a steady state of 30,000-ish units per year in the GTA is for there to be more price adjustment ahead downward in order to get to those better affordability numbers before we stabilize and then get back onto a regular path.
I appreciate that. And I have to admit, so when I was sitting at that conference and you had that slide up, which I have a picture of that slide, I hope you don't mind. And the title on the slide was Demographics is Suddenly a Dark Horse. I'm in the group chat with a few developers and investors in the market. So once in a while, when I see something interesting, I send them a picture of that interesting thing. And that slide was one of them. So I took a picture, I put it in the group chat, and the immediate reaction was pretty interesting, to say the least. Everyone was freaking out, basically. And if you look at that slide by itself, what you described, just to put it in context, again, I want to go back because I think this is very important for people to realize. 2024, 283,000 new people came into GTA as an annual population growth in the GTA area. 2025, it went from plus 283 to minus 21,000, which is a 300,000 person drop in 1 year. And that pretty much continues for the...
Sorry, it's a 21% drop, but it's a 300,000 person delta in the growth rate,
Sorry,
I guess you might say. The drop has only been 21,000.
Correct. But the delta from last year, so it's significant. We didn't have that many people coming in. We had a whole bunch of people leave. And at the same time, based on that diagram that you had, until 2035, you don't really anticipate, like you just said, that we will have that boom again, or that growth, significant growth. And what I heard, and please correct me if I'm wrong, is that yes, we might not necessarily need that boom to get back to a stable condition. Like, it seems like what you're saying is that until between now and the next 8 to 10 years, we're probably going to be, unless obviously there's always outside factors that can change things drastically 3 months from now. But if you take that out of the account, basically we're going to be in a situation that things are gradually going to even itself out. Is that a fair way of putting it? We are still going to be able to have a support for a relatively strong or decent sized construction development industry while responding to the pent up demand, like you said. Did I get that right?
Yeah, I think so. I just want to be very clear that there is, if you take into account pent-up demand, a need for about 30,000 units per year, about 300,000 units in the next 10 years. We need that. And if we get that, 10 years from now, we should be in a great state where everybody in this population projection that the Ontario Ministry of Finance has given us, that everybody has a home, and that affordability levels are back at a 2011-ish kind of level. I mean, that's the dream 10 years from now, that we've added about 300,000 new homes. And by the way, sorry, just as a sidebar, about 100,000 of those are already under construction in the pipeline. They're already coming. So it's 200,000 more that need to get going and get started and get delivered in this time period. We're going to be there. But I also want to stress that we're only going to get there if those affordability levels return to 2011. And that only incomes are always rattling up a little bit over time. We always get a little bit higher affordability through productivity growth in the economy, et cetera. And hopefully that side of the equation will continue to be there, will be maybe potentially even be there more solidly. There are productivity efforts that should be driving more income to households. But leaving that aside, we need to see new product coming forward in the $600, $700, $800 a square foot range, right? As standard, not as the 1 out of 30 projects that happens to have been able to come forward because of one confluence of factors or another, but as standard. Right. And that we have rents perhaps that are sitting more like at about $3.20 per as standard as well. And it's a difficult path to get from A to B. I'll just say, I'm an economist, and they often call us it's a dismal science, right? Because unfortunately, sometimes to get to a good end, you need to go through a period of pain. And the period of pain really is what is going to reprice these projects? What is going to do that? Construction costs will have to come down further, one way or the other, and that's going to have to happen. Some of that can happen through policy, through changing the way we fund infrastructure, because right now it's regressive and it has contributed to the problems that we're in right now, the fact that we fund growth infrastructure off of new housing, which is inappropriate. So we need to change all of that. And that will drive a lot of costs out of the system. Land prices will look after themselves. As things get softer and softer, we'll continue to see land prices going down. Right now, the higher land prices are priced into a lot of the projects that are for sale right now. But tomorrow's projects, next year's projects, as some of these parcels turn over, will have lower land costs built into them. And otherwise, we're going to see potentially some projects going repriced or whatever at lower levels. And that's the creative destruction that gets from one state to another. And it's not necessarily going to be good for every person in the industry, but it's going to be an opportunity for those who know how to navigate that kind of chaos. And ultimately, that gets us to a state where we're producing housing again, and it's more affordable, and we're being able to accommodate these new levels of population growth. Fairy tale? Maybe. But nonetheless, I think that's where we need to go.
I don't disagree with you. If we could deliver housing at $700 a square foot hard costs, Yes, we would be looking at a significant.
Sorry, not our cost. I'm talking about price to the buyer.
Oh, and I
Yeah.
apologize. I should have said the same thing. Hard cost is much lower than that these days. Like we can deal with hard costs in the 400s and
right now. I'll just say that the projects, there are about 30 projects or so that have launched since the beginning of 2024 that are still active. Actually, it's a running total. Some of them are closing up or whatever. But let's just say it's 20. It's not 25 to 30 projects out there. The average price is still about $1,150 per foot.
Right.
So we haven't even gotten those legacy prices to move down. That's a asking of what's there. Sometimes it's a different story about what ultimately, when there is an absorption, what deal might have been made. But nonetheless, those are what those asking prices are right now.
Correct. And to correct myself, yes, the hard cost these days for many of these projects is ending somewhere between 400 to 500, maybe a little bit higher than that, depending on the scale of project. But I want to throw a wrench at that fairy tale dream that you were just describing, which I would love to see. Build Canada Homes. Anna Bailao and their team and Mark Carney and everything else that is happening right now. How does that come into picture? Like they are projecting that the government is going to get involved. Obviously, that's their mandate. They just announced one of the projects that one of them that I'm aware of in Downsview Park in Toronto area. I believe it's aimed for like about 500 units. Obviously, it's a drop in the bucket, but at the same time, it's a good thing, I would say. Or is it a good thing? As an economist and the invisible hand at play, you're having a not so much invisible hand also coming into play. Where do you stand on that?
Yeah, I think it's a good thing. I'm not sure if it's enough or if the magnitude is, but we'll see how that evolves. It's new. And it's competent. I think it's also an initiative that's competently being led. The policy is coming from the right direction. So we'll see about the details, but I'm pretty optimistic overall. But we change terminology, we change focus and so on and so forth over time for one reason or another. But the Build Canada is essentially Canada getting back into social housing, which I think is a good thing. We used to build a lot of social housing units in this region, in the city, in the GTA, back in the 80s, up until even in the early 90s. And then they got choked off by both federal and provincial government getting out of that business. And deeply affordable units just didn't come into the pipeline unless they happened to be filtered out of the regular process or whatever, in the sense of older stock or whatever. But new deeply affordable units wasn't part of the development picture for about 20 years. And then we saw governments try to get back in from a policy perspective on providing deeply affordable units, but all of those policy initiatives in one way or another levered off of finding the development community, figuring out a way that the development community could deliver them, right? So inclusionary zoning or density bonuses or whatever, some scheme or another in order to deliver deeply affordable units through the provision of market housing. And that's been a bust. And it's not just a GTA thing. For years, I've been studying ways to deliver affordable housing, and I've looked at examples through the US and how different policies, and none of those policies have ever been very robust in bringing forward units. And all that they ever do in California, if you look over the history of California and see how prices have reacted, it's a mirror of what we've seen in the GTA recently, which is that inclusionary zoning type programs of various types have ultimately just added to the cost of market housing. That's all it does. It pushes up the cost of market housing in order to try to deliver these forward. So Build Canada is not that, or at least it doesn't appear to be that at this point in time. It seems to be injection of real government money, not just a kind of levering off of something or other, and really bringing forward what we might have called social housing at one point in time. I don't think it's going to look and feel and whatever. It still may be mixed. I think they're still trying to get into mixed income communities and so on and so forth. But nonetheless, it's effectively real government money coming towards units. Is it enough units for what we need in that deeply affordable strata or segment? Probably not, or probably not yet, but we'll see how that evolves. But it shouldn't interface too broadly with the market housing discussion that we're having that requires these broader macro kind of strategic changes in order to get there. This is really dealing with that deeply affordable segment, which is an important segment, but is a segment that really should be the government's responsibility. It really should be the government's responsibility. And so hopefully that's where we're going.
That's perfect. I want to go back to where we were on on your slides and your presentation that I had the privilege of sitting through. There were a couple of things there that were pretty interesting to me from that presentation. One of them was, and this is going more granular into the demand and supply over the next few years, or 7 to 10 years, 8 to 10 years in GTA area. A couple of things that you had mentioned, which I found interesting, was one of them was the downward trend of the rental apartments between the 20 to 35-year-olds, which I guess lines up with the whole non-permanent residence trend that you were just describing. So I guess your forecast, if I think that's a correct word, your forecast is that for the next 10 years, the overall trend for this non-permanent student housing is not necessarily positive. Is that a fair way of putting it?
I think that, let me just say the positive to begin with. I think that I painted a picture about what we need and where we should go in the next 10 years. And the positive thing is that where the demand is going to be strongest is going to be for family units, because the dominant demographic going forward in the next 10 years in the GTA are people who are the age of 35 to 50. And they tend to be getting to be wealthier couples or couples with children or families with children, sometimes young, sometimes starting to grow up in those age groups. And that's where a dominant part of the growth, almost half of the growth that we're going to have, of the population growth we're going to have in the next 10 years, is going to be in that segment. Another segment is this sort of 65 plus segment. That's not a surprise to anybody. We're in an aging population which has been growing. But those units also, or that demographic itself also requires a certain type of unit, assuming that there is turnover in those age groups, which there are, and some downsizing and stuff. But the downsizing is towards larger ground-oriented condominium apartment units and/or ground-oriented towns, and maybe if downsizing, but not necessarily downsizing the typology, right? Going from a big single family to a smaller single family or a town or something. And those are the demographics. That's where there's going to be a lot of niche opportunities. I'll say that there's a demographic in the middle between those two things that is not growing very much. That's that kind of 50 to 65 group or whatever. That group that's not an area of growth in Canada or in the GTA in the next thing. And so there are some segments that people are focused on or have been focused on that appeal to that type of demographic in the past. And that has been a high growth in the past. And that would include like cottage country, and it would include second homes. It would include so-called 55 plus lifestyle communities that have been popular, fractionals. I haven't heard that for a while, but that was a thing that appealed to that demographic, and so on and so forth. A lot of those niches are not going to be fairly dominant, I don't think, in the next 10 years because that middle demographic. And then finally, you've mentioned the younger demographics, what we might call 20 to 35-year-olds, which is singles, people generally trying to find their first home, which is often a rental apartment, and sometimes also their second home within that same period of time, that reflects rapid changes in lifestyle that happened during that period of time, including coupling up, getting married, having kids. That all happens in that time period. And so you drive a lot of different kind of typologies in that group. Again, just drawing from Ontario government's projections right now for the GTA, that group is set to decline by 120,000 people in the next 10 years. In the GTA. Wow,
that's a big
number. So,
that's the size of Barrie.
We're going to lose a Barrie worth of young people.
Yeah, young people.
And that growth path that I described earlier about it's okay to have population stalling, or as long as you're going to get to a improved affordability and then you're going to draw out. This is the group that has the most pent-up demand in it already. Lots of pent-up demand in this group right now of people staying with their parents basically, or bundling up, and so on and so forth. So you can draw that out. There can be an opportunity of drawing that out. But again, it has to be with much more reasonable rents than where we are. Even now that rents have adjusted probably by about 25% or so, probably, depending on whose measure you're looking at, more of an adjustment ahead. And of course, for some entry-level apartments and I think that will probably happen because we are probably oversupplied in very small condominium apartments. So that will probably be a segment which will lead the further price adjustment. And then that might actually solve some of the affordability in that group, and then we'll release some of that pent-up demand. But the basis is that where that growth group is not growing like it was in the last 10 years in the GTA, which, by the way, in the last 10 years, that group, that segment I'm talking about, the people who were at over the last 10 years, 20 to 35, obviously everything keeps growing each year. That group grew by 500,000 people in the GTA, added 500,000 20 to 35-year-olds over the last 10 years. And that's what's driven the demand for the small units. That's what's driven rental apartment construction in the GTA going from virtually nothing up to, right now, it's 70% of the apartment supply. That's what's driven it. But that's not necessarily what's going to be. The future is not going to look the same as the last 10 years.
And I think that's key for anyone who's starting up new projects to have that in mind, that, like you said, just population growth is happening. The wave is moving forward, if you may. So unless we get new young blood in the GTA area, which comes with other issues as well, the next 10 years is going to be different from the last 10 years. I want to kind of open a bracket here quickly. I was at the apartment investment conference a few weeks ago, and the general sentiment over there was not necessarily dislike what we were discussing. I think the general sentiment was, yes, there's going to be a few, call it rough years for the industry, for the investors, for the portfolio holders, and even for the builders and developers. But at the long term, like in terms of decades speaking, this is probably just a blip on the radar, and it will balance each other out, and you will be in a good position, which I think lines up with what we just discussed. I'm putting that context there because I guess my next question is, if you're a developer these days, if you're looking at a multiplex, sixplex, which is becoming very popular these days, is it fair to say it's the right fit for you if your investing horizon is 10 years and above? And don't go into it assuming that you're going to get a cash out, you're going to get a return on the payback within 3 to 5 years, which could have been the case with that previous 10 years. But is that a fair assessment? Because at least that's how I'm feeling when I'm talking to these new developers and I'm seeing the numbers. I want to see what your feeling is.
So you're talking about somebody building and then holding it as a rental investment. I think you're probably right. Without running some numbers or whatever through the piece, but I think some of the story that I've been trying to tell is that if you're able to bring a project forward where you're able to drive some cost out of it to begin with, either taking advantage of some lower land values, taking advantage of some of the relief right now on government charges that are happening in some markets in the GTA anyway. Some of those are temporary, by the way, so it's true, to take advantage of where it is. Take advantage of some of the financing assistance programs that the federal government still are trickling out. Bring those projects forward in a way where you can build a unit that appeals to the growing demographic, which of course would be larger units, and sixplexes, et cetera, are almost ground-oriented and community integrated almost by design. So those are positive attributes. If you're able to do that, then I think you're going to be able to be on the kind of more positive side of the rental growth path going forward. I think not all units will see rent adjusting in the same way going forward, because I think a lot of the stress is going to come from excess number of very small units, right, where we'll probably see rents adjust, being more sensitive as a result.
Right.
But that being said, and also I think for those small projects, you just have scale on your from a risk profile perspective. You just have scale on your side, right? That you're taking a lower risk and you're bringing a product forward that's likely to see some uptake in the years ahead, and you're probably moving in the right as long as you can manage that risk at that scale.
Yeah, you're probably moving in the right direction. You shouldn't be counting on being able to make all the numbers work very quickly. It probably will take a little bit longer than you anticipated, but that's what the sentiment it seems to be on the street right now. I want to try and wrap this up by quickly asking you to talk about retail and office. I know when you and I had a side discussion before the recording, you had mentioned some numbers on the retail, how much retail there is, and there might be a little bit of oversupply. And I'll open the mic to you. Where are we with the retail and office spaces? What do you think is going to happen over the next few years?
I'll deal with retail first, because retail has a real integration into small scale residential development as well, because we often see some retail integrated, or at least aspirationally integrated into these projects or into other projects. I think the retail sector is doing relatively well in a medium-term context in Canada. It continues to attract investment. We've seen capital investment going into retail, both new and CapEx going into retail at reasonably strong levels in the last couple of years, despite the fact that we've undergone a pretty significant transition towards e-commerce and some of these other issues that everybody is pretty familiar with right now. I think going into the pandemic, Canada was fundamentally not overstored. Like, I think we were appropriately stored, whereas the U.S., we look back now and it's was very overstored, probably still is. And so we've seen a lot of communities in the U.S. where retail assets have lost a lot of value and have had to be removed from the market. And that's not fully the case in Canada. There continue to be segments that are stronger and weaker in Canada. Food-anchored plazas continue to be the darling and are for a while. They seem to be doing very well. And our largest malls are doing well as well. The premier malls are doing well as well. Small enclosed malls a little bit less. And Main Street, I think, is holding its own for the most part. But the issue, one of the issues as it interplays with residential is that in terms of so I'll just say one other thing as well, is that we have shocks from time to time in this country, retail shocks. It's major retailers leave. As a major U.S. retailers come in, Target, and then they leave. And sometimes it's because we lose something like the Bay more recently, right. And Sears back in the years, and so on and so forth. But again, our fundamentally not overstored status means space will get absorbed. It's in certain assets and stuff in the short term, but it's not a death knell for centers that they're in. In terms of the integration into residential, we often are too aspirational in our planning, and planners are, in the sense that this idea about having a mid-rise residential building on a Main Street setting is very attractive, and there is demand. We've talked already. That's a nice infill project. There's lots of stuff that can go for that. And then the planner looks at that and says, well, let's put some stores in there as well and have a animated street front, as they say, and other things like that. But it adds a lot of cost to the project to do a mixed-use project, particularly in a small project. And the style of retail unit that you end up with, for one reason or another, it's often not the right shape and size and function and so on and so forth. There can be some integration issues with the residential, depending on for certain uses, like for restaurants, et cetera. And the cost points are not the same as a purpose-built single-story retail use somewhere. And often the parking criteria doesn't line up with what retail tenants are looking for. So I think that if you are successfully able to pencil out a project that has some retail on the ground floor, for one reason or another, if you're able to do that, often because you might be bringing maybe at a time when you could offload a lot of those costs onto the price of the residential, then you may end up with kind of empty units, or you're going to face an uphill battle trying to find demand. National tenants don't like them so much, whatever. Anyway, there's some problems with that. So I like to see retail planning being on retail nodes and so forth. I like to see Main Street planning being a nice integration of the old Main Street and infill housing where we can find it, and integrating it in that way using streetscape and other infrastructure in order to animate these areas rather than a continuous wall of stores. And that way we can deliver the housing in a more affordable way, and we can deliver the retail in a more affordable way, and both coexist and build off each other. So we'll see how that evolves, but I would like to see. I'll just take a side note and say here, this actually applies to all of this topics that we're talking about today. And I spoke at the OPPI conference, which is that's the Association of Planners, just earlier this summer. And here I was talking about issues of planning policy and how it might be misaligned with the market and where we should be going. But one of the things that we might be on the cusp of right now, as we go through this period of creative destruction, which I've mentioned earlier, which is this, everybody is rethinking everything now, right? That's what a crisis brings. And I'm hoping that this might be an opportunity for us to get through to some of the planning policy folks and to significantly rethink some of these continuously built-in cost factors that have come into the planning framework. And we may actually be successful at this point because of the chaos that we're going through You need to do all sorts of stuff. And then very briefly, I'll just address your office question. And there's a lot of parallels to what we're looking at on small units in the GTA when we talk about office more broadly. The office market right now is fundamentally oversupplied. We have about 100 million square feet of basically functionally obsolete, unusable space across the country, and about 40 million of that in the Southern Ontario GTA and slightly broader area. And that space, we need to do something with it. The reason why we have excess space, people realize that a lot of people have moved to hybrid work, and that's driving some of it. But a big part of it is we've had a real efficiency revolution in office. One of the things the pandemic did is it drove this efficiency because it drove everybody into a paperless office environment. And you talk to people who, it doesn't really matter what sector you talk to office workers in now, they don't need the filing cabinets and they don't need the rooms where they used to put reports together. And that's happened very rapidly. And if you look at a new office, which is being fitted out right now for a new leaseholders downtown Toronto or wherever else, it's being fitted out at half the size that it would have been even 5-6 years ago on a per employee basis. And that's happening slowly. That's happening for new leaseholders now, but it's going to continue to happen slowly as existing spaces rationalize over time or whatever. So office demand continues to be very weak. People think that it has something to do with the economy, but it doesn't. We've generated 500,000 net new office jobs in the last, since the depths of during the post-pandemic recovery. And we've had virtually no absorption. We've just had the negative absorption from the pandemic continues to be the dominant piece. So that's the situation we're in. Now an important caveat on all of that is that we do have office demand. And the office demand we have are modern, appropriate buildings in downtown cores in great locations, purpose-built. I'm using the word purpose-built, but what I mean is single-use office buildings that are up to modern standards are incredibly different than buildings from even 20, 30 years ago. And that's where they're in the leasing market right now. That's what companies are scrambling to get into and fitting out at these new ultra slick floor plates, et cetera. But we don't have anybody planning to build those right now. I guess some people are planning to, but we don't have any starting right now, going forward, because the industry that owns the office sector, which includes our pension funds and others, they're holding this 100 million square feet of, we need to release capital out of this old stock. And one way we do that is to convert those buildings that can be converted into other uses, residential, but there's some other uses that can be done, and or redevelop the site for a higher and better use, pull the old building down. And unfortunately, we continue to have pretty strong resistance from a lot of municipal governments around doing that. And if you have to go through a 3 or 4 year dance with the municipality to prove to them that this 1980s, 1970s office tower that's on your site is an inappropriate use and that you would like to bring forward housing or other uses on that site, then that's a cost factor as well. And that cost is all just going ultimately into the price of the housing you're doing. And right now, we've already discussed we should be lowering cost factors, not raising them. So that's an area that I would like to see significant policy changes happening as well. And I think that we're going to have that, hopefully. I'm more optimistic that we might be able to have that now that we're in this state of chaos.
And to go back to the planning comment that you were making earlier, I had the opportunity and privilege of sitting down with Jason Thorne and his team at City of Toronto, our chief planner, and we were discussing some of their initiatives very specifically on the mid-rise section of the market in terms of enabling more mid-rise buildings and infill projects happening. And kudos to that team. They have a lot of good things going on, good programs and good ideas, and they are aware of the pain points. Yeah, but obviously, unfortunately, as part of the government movement, it's very slow. It will take years, and it might be a little bit too late, but hoping that they can move that faster, especially on the comment you made about the retail spaces in mixed-use buildings. Yesterday, I was talking to a developer that has an 8-story building, about 20,000 square feet, and they have to do the retail on the ground floor, which just kills the performer.
Yeah.
No one's going to use that space. It's so small. You cannot have a commercial kitchen. You cannot have a back storage area. And I struggle to see who's going to ever set up shop in that space, right? And that's just a disfavor to the project, disfavor to the community, if you may. So definitely I'm with you on hoping that requirement will eventually or gradually change and improve to fit the realities of the projects that we're doing. We have a question sometimes we ask at the end of this podcast interview from our guests. If we were to give you a magic wand, Peter, and say, here's a magic wand, you can make one wish, you can make one change in any realm that you like, in the economy, regulation, policy, mindset, paradigm shifts, whatever you like, to help us improve the outlook of our country, of our industry, of our housing market, you name it. You take your pick. What would that one wish be?
I'm going to go back to something that I mentioned earlier in this podcast and in my remarks and use that as my magic wand answer. And that is the infrastructure finance, the growth infrastructure finance that we do through DCs and other municipal measures, many of which end up getting charged back to the developer and ultimately to the home builder or the renter. And the reason I'm saying is that my magic wand is not to have more municipalities doing like Vaughan and like doing Burlington or whatever, and having some minor changes for a temporary period of time or whatever, like little relief, targeted relief during a period of crisis. That's not what my magic wand thing is about. And in order to enact my magic wand, I'm going to bring us back, not 10 years or 20 years, but back to when we built a lot of the housing stock that we have in this country in the post-war period. And we built our communities at that point in time. We supported growth. We built growth infrastructure by municipalities planning for it properly and then taking out big debentures with their low government financing rates and building that infrastructure and then growing their communities and then taking the additional tax, their tax base grows, and then paying that debenture off over years with the tax base. That's how we grew our communities. And those were through periods of extraordinarily strong affordability and growth and prosperity for families in Canada, et cetera. And that's really where we need to be on financing growth. We had this kind of about turn that started in about the mid-90s, but really got going in the 2000s in terms of a philosophy of growth infrastructure to say that why should me and my 100-year-old house be paying for new condo development downtown or a new townhouse development out by the racetrack or whatever. And then that, and of course, people in existing homes, 100-year-old homes are the ones who are voters, et cetera. So there's a political economy that gets to a new state. And that new state says, let the newcomers pay for all the growth-related infrastructure in our community. So we need to get back to what we did before, because I think that it's a sustainable solution. Getting from point A to point B, where you fundamentally change the picture, is very difficult to do, right? To just suddenly take all of those costs and figure out how municipalities are going to finance and do them and go forward with them. There's a myriad of problems with it. So that's what makes it ideal for a magic wand, because then you don't have to worry about all those messy transition issues.
We definitely
let's get to a sane way of financing growth infrastructure.
Amen. I couldn't agree more with you. That's a big ticket, and it has a ripple effect, which we can probably talk about the ripple effect as well for quite some time. But thank you very much, Peter. This was very informative. I very much appreciate having you on the show. I'm hoping this is your first time and not the last time. We get you back in a year or two and we go back through some of these discussions with more positive spin. Hopefully some of these fairy tales and some of these magic wand discussions start happening and we at least see a little bit more light at the end of the tunnel.
I appreciate you having me on the show. Thanks very much, and thanks to all your listeners.
Thank you. Just one last thing before you leave, please make sure to visit our website. We have put together a whole bunch of different resources that you can download for free from our website. These include checklists, manuals, and also access to previous webinars. In case you have missed any of our previous webinars, you can go there, get the replay link, download the slides, and benefit from all these free resources that we've gathered on the website. Please make sure to visit. Thank you.